Okay, so if you've been riding the wave of those major tech stocks over the last couple of years, kind of just letting that easy mode carry your portfolio forward, well, I've got some news for you. That era, it's pretty much over. Welcome to our Q3 2026 Global Market Intelligence Briefing Explainer. Right now, we are witnessing a massive structural shift, what we're calling the Great Rotation. The market is literally rewiring how it values assets, and today we're going to look exactly at where the smart money is moving and how you can position yourself to take full advantage of it.
Okay, let's dive into this. We're going to funnel down from broad global pressures directly into granular corporate winners. So, we'll hit the great market rotation, global geopolitical pressures, the passive investing cycle, revenge of the middleman, new frontiers and winners, and then cap it off with your Q3 strategic playbook. Starting right off with Section 1, the Great Market Rotation, the S&P stupor and the end of Mag 7 dominance. Right now, the overall market is kind of holding its breath.
Take a look at this number right here, 7,500. Ever since mid-May, the S&P 500 has essentially been stuck in this really tight torpor right around the 7,500 point mark. The broader index is basically paralyzed, just waiting for critical earnings reports from big tech giants to tell us if we're going to break out or break down. But while things look super flat on the surface, underneath there is a violent reshuffling of capital going on.
What's really interesting about this slide is the stark divergence we're seeing. On the left, retail investors are actively yanking capital away from the cooling Magnificent Seven, companies like Microsoft, Apple, Amazon, and Nvidia. It's hitting so hard that the semiconductor index actually dropped 20% from its late June peak, officially crossing into a bear market. But look at the right side. That capital isn't vanishing. It's pivoting directly into undisruptible next-generation AI infrastructure. The biggest spotlight here is SpaceX. To save a sliding stock that recently hit an all-time low of $123.99, SpaceX is pulling off a massive $26 billion pivot to orbital AI data centers. They're negotiating huge contracts with the DoD, Anthropic, and Google. It is a complete rotation from software hype straight into heavy physical infrastructure. Moving on to Section 2, global geopolitical pressures and mapping the world's flashpoints. Because to understand this rotation, we first have to look at global friction. Move to this slide and see how this builds. We're seeing a massive shift where totally interconnected global events are radically reshaping market mechanics. It's no longer just about the free flow of raw global commodities. It's about elevated local margins being driven by geopolitical flashpoints. Let's rapid fire through some of these hotspots, because it's wild how this all connects. In the Middle East, U.S. and Iran missile and drone escalations are driving intense regional instability and oil anxiety. Over in the U.K., Andy Burnham just became the 6th prime minister in 7 years, inheriting a totally crippling housing crisis. In Asia, we're tracking China's non-military subversion of Taiwan, and they're doing it through fascinating, creative avenues like children's choirs and barista competitions to undermine Taiwan's standing. Crazy, right? But it's not all conflict. Cultural pressures are shifting capital too. Spain's recent World Cup win over Argentina is providing a massive economic boost to U.S. host cities. Meanwhile, domestically, U.S. parents are lobbying hard to restore shrinking school recess times, reshaping local community focus. All of these seemingly isolated events create the friction that disrupts global trade and fuels the rotation we're seeing today. Let's jump into Section 3, the passive investing cycle and the blind lift of index funds. This is a real aha moment for how money actually moves today. Okay, let's carefully walk through the 4 stages of the passive investing vicious cycle, because this mathematically punishes active stock pickers. Step 1 is passive inflows. Cheaper index funds win retail capital, and they just blindly buy stocks based purely on market weight, totally ignoring underlying value. Which leads to Step 2, active redemptions. Active fund managers face outflows and are forced to sell their carefully researched off-index picks just to meet withdrawal demands. Then we hit Step 3, asymmetric price pressure. Those favored off-index stocks suffer price drops from the forced selling, while the index stocks get this massive blind lift. And the mathematical result? Step 4, active underperformance. Because they're punished for trying to be different, 4 in 5 U.S. active stock mutual funds actually failed to beat the S&P 500 last year. And you know what that does? It just drives frustrated investors right back to Step 1, feeding the machine. Famed investor David Einhorn completely hit the nail on the head here. He said they're going to assume everybody done the work. This is the incredibly dangerous assumption fueling a multi-trillion-dollar passive investing machine, just assuming someone else out there has already rigorously priced these companies based on their actual fundamentals. That brings us to Section 4, Revenge of the Middleman, profiting at the choke points. While active pickers get squeezed, a whole new type of winner is emerging, the structural intermediary. Check out this number, $69.45. This is the current record-breaking 3-to-1 crack spread in the energy market. Basically, that's the profit margin refiners make turning crude oil into gasoline and diesel. To put that into perspective for you, the historical average for this spread between 2018 and 2025 was just $23.19. So we are looking at a metric that absolutely dwarfs historical norms. This brilliantly illustrates exactly what's happening. When you break down the cost of a single gallon of gas, the reason for the spike is super obvious. Refining constraints caused by Middle East and Russian geopolitical tensions have made global capacity incredibly tight. And because of this choke point, refiners like Valero and Phillips 66 are capturing completely unprecedented margins. Their refining cost share has jumped from a historical 15% all the way up to a massive 21%. So the gas stations and everyday consumers are left to absorb the pain at the pump, while the structural middlemen capture all of the geopolitical premium. Section 5, New Frontiers and Winners. Corporate shifts from entertainment to pharma. Let's zoom all the way into the micro level to see specific corporate winners and losers in this unique environment. We're seeing an unbelievable contrast right now between companies prioritizing premium physical experiences and those totally bogged down by bad planning or digital fatigue. In the winners column, we have Adidas, who successfully captured the Spain World Cup bump with a massive 100% surge in website traffic. We've also got IMAX pulling in a record $51.8 million in sales for premium, large-format 70mm physical experiences. But on the losers' side, Nike exited the Olympics with no turnaround, plagued by out-of-stock Team USA inventory and the early exits of their heavily favored sponsored teams. And in entertainment, Disney is getting actively punished for what we call designated scroller fatigue. Their Lightning Lane technology basically turned a magical theme park experience into a stressful, income-dividing mobile management chore, and consumers are pushing back hard. Here is another massive frontier, the intense pharmaceutical race to replace Keytruda's $32 billion sales patent, which is set to expire in 2028. This table breaks down the two distinct approaches battling for dominance. On one side, you have antibody drug conjugates, championed by players like Astra and Pfizer. Think of these like precision smart bombs, destroying cancer cells directly with highly localized chemical agents. On the flip side, you have bispecific antibodies from companies like Bristol-Myers Squibb and Summit Therapeutics. These actually work by blocking the PD-1 stand-down signal that cancer cells use to hide, effectively rearming the body's own immune system to attack. This race for the next big immunotherapy breakthrough is a huge source of potential alpha in the coming years. Finally, Section 6, the Q3 Strategic Playbook, formulating an active strategy. Time to turn all of this into actionable intelligence for the rest of the quarter. We've explored the mechanics and the winners. Now let's break down Goldman Sachs' three-pillar thesis for navigating this environment. Pillar 1 focuses on consumer experiences. Like we saw with IMAX, high-end physical experiences are fundamentally insulated from AI disruption, and spending growth here is actually accelerating. Pillar 2 targets compounders. These are companies yielding consistent earnings growth and strong free cash flow, currently trading near 10-year relative lows against the equal-weight S&P. And Pillar 3 highlights M&A targets. Easy financial conditions are fueling corporate acquisitions, with deal volume surging to a staggering $1.2 trillion. You're also going to want to keep a close eye on the gold seasonality trade. Despite a recent pullback in price, the historical data points out that we are just entering the absolute best seasonal window of the year for gold, running straight from July through October. The historical bullish bias here is exceptionally strong if you are looking for a strategic defensive play. So, wrapping up our strategic takeaways, the crucial point is this: your strategy absolutely must adapt to these new realities. First, look beyond the pure play hype to the picks and shovels. The Magnificent Seven are consolidating, so future alpha relies on things like SpaceX's data centers or undisruptible physical alternatives. Second, understand and capitalize on the structural middleman. As index funds dictate massive blind price pressures, intermediaries like oil refiners are capturing record spreads at those choke points. And third, prepare for squeezed volatility. With geopolitical conflicts threatening commodity spikes, Q3 demands true defensive agility and precise active stock picking rather than passive reliance. Which leaves us with one final, deeply important question to consider as we wrap up this explainer. Knowing what you know now about the structural vulnerabilities of the market, are you still relying on the passive index machine to do the work for you? Or are you finally ready to take active control and navigate the great rotation? Thanks so much for joining me for this intelligence briefing, and I highly encourage you to look at your portfolios through this new lens today.